It's time to check your money with Mike Jennings, your friendly neighborhood advisor. Mike Jennings is a wealth advisor with Brackens Financial Solutions Network, LLC, and a registered representative of LPL Financial, member SIPC. Mike, what's going on, brother?
I'm good. I'm good. I'm doing real good. I know that we talk about the weather all the time. We really need to stop doing that, but
Yeah, yeah. So let's not do it.
let's not do it. I'm
Basically, what
enjoying
you want to say is that there's a little crispness into the air.
it's a little crisp, right? But it's that nice, it's that sweater weather, as they call it. So, it's nice being able to go out with a couple layers on and not have to, so I'm digging it so far.
I think it's fly weather to me. Like you could really like just kind of put some things together.
Exactly. You know what? I think we talked about this too. So you know what? Let's go dive they like they keep talking about the weather. It's like classic. All right. So last time we spoke a lot about financial emotional behavior and its effect on how people use it and relate to money, right? Um,
Yeah, you talked
Now
about a financial therapist.
we talked about a financial therapist, exactly, right? So with that, I mean, we know money is an emotional thing for most people, which is exemplified 24/7 by the financial markets. We also talked a bit about AI last week and how it's making its way into every single part of our lives. So, if we focus on the relationship between those two things, right? An emotional stock market and AI, we pretty much can close in on two pretty monumental things happening in our world right now. And that is the AI boom that we're seeing, where established businesses and all these new startups that are tech-based or even have just a smaller tech component are attempting to get on the AI bandwagon. And with that, with that comes the rising concern of whether or not we are experiencing an AI bubble. So, are you ready to
Hmm.
get into it this week, George?
Let's go.
All right. So right now, like I mentioned, there's a major focus on AI in the business financial world. The tech sector overall is the leading factor in much of the growth that we've seen in the market in the last almost 3 decades.
It
Um,
occur, but you know what occurs to me
what's that?
that there may be one person in our audience that doesn't know what AI means.
Oh, AI. Now, when I say AI, of course, I'm talking about artificial
For
intelligence.
that one person.
For that one person. I know a lot of you out there may have heard of Chat GPT, Open AI, Sora, all the different things.
Yes.
That's what we're talking about here.
Okay.
Um, yeah, so like I'm saying, and I'm sure a lot of people out there are familiar with, the S&P 500, which is the grouping of the 500, actually 503 leading companies on the market. Now, what many may not have heard of is the Magnificent Seven, and that's going to be a great illustrator of what I'm talking about here. So, George, have you heard of the Magnificent Seven? And I'm not talking about the old Western, but that is where the name comes from.
I'm thinking of these are the seven companies or the seven industries that give indicators for the growth of the economy, something like that. Is that what we're talking about?
Pretty much. So, if the S&P 500 are the top 503 most valuable companies on the market, then the Magnificent Seven are the top seven most valuable. And they are all, as you can guess, big
Tech
tech.
companies, yes.
Big tech. So you have Alphabet, which is Google, Amazon, Microsoft, Apple, Meta, which is Facebook, and the more recent additions of Tesla and Nvidia, which
Mm,
is actually an older company, but now stands as the most valuable company in the world.
because of
And
the
it's all
AI.
because
Right.
of AI, exactly. And again, while it may seem great to many people that we are in this tech renaissance, you can say, and we might see a lot of different benefits and different uses for AI and a bunch of other innovations. We currently have to deal with the reality of a possible bubble. So, and speaking of that, what is a bubble, right? So, an economic or speculative bubble, stock market bubble, whatever you want to call it, it's when the price of something, an asset, in this case, it would be stocks, but an asset is excuse me, overvalued beyond what historical and current trends would suggest its
Mhm.
value should be. Um, And it can happen, I mean, generally with anything. Commodities. I know Vicky talked about the tulip mania before, which is the first bubble and the first economic crisis in history.
Hmm.
Real estate, the housing bubble was a major component of the 2008 financial crisis. Things that are already highly speculative, like cryptocurrency, of course. And then obviously, again, the stock market. So a bubble is typically hard to distinguish while it's still inflating, and generally it's categorized, or they are categorized as a bubble after it pops. It's sort of like a recession. Like, a lot of people say you can't really call a period of time a recession until after you come out of it. It's like, oh, well, that was a rough period of time. It's like, oh yeah, that's a recession, right? It's almost the same thing with a bubble. It's not until it really pops and you start to see the effects of it that you can say, okay, yes, was indeed a bubble, right? Um, Now, obviously, when that bubble pops, the value of the assets involved decreases. And that decrease can be dramatic, depending on how overvalued the assets became in the first place. And it's also tough because value itself is subjective. So, value is subjective, but the thing is, when you invest in companies on the market, on the stock market, the price is the price. You're paying the market rate at the time of the purchase. And it's whether it matches the company's realistic value or not. That's the way the market works. So the more interest a stock receives from investors, the more the price can increase, which attracts more investors, more price increases, more investors, more. So now you got this cycle. And if that cycle happens at a rapid pace because of growing popularity or a boom, per se, many would say that a bubble is being inflated and that eventually it has to pop. Now, the interesting thing is that many listeners out there may remember that we've been through a very similar situation before. Now, I was only 5 or 6 years old at the time, but it was pretty significant. And do you know what I'm talking about, George?
I do, but I can't call it right now.
There you go. And that was the dot-com bubble of
Right,
2000.
that's what I was
Tech
thinking of.
bubble.
Yes,
See, he's gotta go with it. He's gotta go
yeah,
with it.
yeah.
Um, so for those that don't know, during the 90s, the internet was in its earlier form, but it was becoming more and more accessible to the greater public, to consumers. Now, this led many businesses, especially startup businesses, to jump on the bandwagon and, sort of create or come out with some tech product or service without really having a long-lasting business model for how they were going to utilize the internet and everything that they were going to do on there. And they all sort of collectively had this thought of, hey, we're on this new thing, the internet, and it's going to be huge, and we're going to ride the wave to success. And we just gotta put it on the internet, put it in auto drive, and that's it. In reality, the internet back then wasn't what it is today with all of the capabilities that it offers consumers and businesses now. And all of these companies and startups oversaturated the market. They ate up all the venture capital out there, all of the investors. They grew to be overvalued. And when that bubble popped, it pretty much wiped out tech, the whole sector. It was the Thanos snap of the business world between 2000 and 2002. But really, what it really did in the long term was set the foundation for the next 20 years, right? The allure of the internet didn't decrease. It was the exact opposite, right? The internet became more popular. It was the last frontier of business. The internet took every manner of shopping you can think of from something that happened outside and put it in people's homes and
Hmm.
eventually put it right in their pockets.
I got a side note for you though.
Yep.
Mark Cuban made his money in the dot com burst.
So
Okay,
did one of his co-hosts, Kevin O'Leary.
really? Okay, because
Yep.
I think Cuban had broadcast.com or something like that, but he was able to cash in
Yep.
before the bubble.
Absolutely. Absolutely. And to that point, there were a lot of companies that a lot less than the ones that went out of business, but there were a lot of companies back then that saw an opposite effect of that bubble. Um, Obviously, they were some of the stronger companies back then, and some of them lost up to 90% of their stock value after
Wow.
the bubble popped, but they endured, and they now had this fresh playing field in the tech sector, in the market, right? It was like if somebody smacked the Monopoly board 3 hours into the game and they were the only pieces left with some money and some property. They were able to dominate the market. They were able to eat up and acquire a bunch of the smaller tech companies that still existed, and they were able to expand and innovate their products and services. And now, four of those companies that survived are now part of the Magnificent Seven. That was Amazon, Microsoft. Who was around back?
Better.
No, Meta wasn't around back then.
Oh,
Meta
no,
and
no,
Google
no,
were
no,
created
no.
after.
Yeah. Oh, you
Uh,
talking about before this?
Before, oh,
Yeah.
Meta, Microsoft, Amazon, Apple was around. What's the third one? Whatever the case may be. The ones that isn't Tesla and and Nvidia, that was it. Nvidia, that was it. The most valuable company in the world, Nvidia. It was also back then, they were more focused on video games and stuff like that. So to see where they are now is sort of crazy. But they all endured the tech bubble and are now major contributors to this AI boom that we're seeing. So I guess the question is, why does this matter to our listeners out there? Well, obviously, it's because many of you are investors in some shape or form. Some of you have, yeah, your retirement plans, your brokerage accounts, your IRAs, all the manner of things. Many of you are funding your retirement plans that include equity in companies, and many of them are most likely tech companies. If you Whether you're doing individual stocks or whether you're you know, investing in different funds and things like that, a lot of them are going to be tech. And if we are in a bubble and it eventually pops, it won't just be those tech companies that will suffer. Obviously, they will suffer the most, but it will be all the companies in that tech radius.
Mm.
The
Hmm.
companies that may not have their own AI model, but they may manufacture parts for AI. They may manufacture parts for tech and I mean, we're in central New York. We all know Micron and things like that. So if you listen to, the county's plan, it's not just about getting Micron here. It's also about courting, I think the number was 90 plus other companies that are to support the Micron and support the supply chain of everything that comes from that as well. That's a lot of companies.
Yeah.
Um, all the companies that, they're not just supporting well, they're supporting the efforts of AI-based companies. And like I said, there's a lot of them. It's it's really situations like this where not just having a diversified portfolio is of the utmost importance, but really understanding your portfolio is important. Not just having those few different funds in your account, but really going into those funds, seeing what companies are in there and how much stock of those companies are in there, right? Beyond that, consider what happens when a company loses value, right? They had to cut costs. One of the first ways that they do that is by letting people go. So now you're talking about real people losing their actual means of living. Now apply that to a whole sector of the market, right? We're talking about tech, AI, and all this stuff. That would just simply not be good. So how close are we? I guess is another question. How close are we to being in a situation similar to that tech bubble? Many people say that the signs are there. We have a major focus on a particular sector of the market, being tech and AI specifically, um, with established companies and again a lot of startup companies joining the hype daily. I mean, obviously, we have a great organization here, Center State. We all just celebrated the new Inspire Innovation Hub,
Oh,
but
yep.
there's a lot of startups over there that are into AI and drones and a lot of tech and everything, right? Um, so very clearly, this is a popular sector of the market in business overall. The broader applications of AI are still in an earlier form, very similar to how the internet was utilized back then, right? Back then, the internet, the internet was there, but you couldn't even be on the internet and on a landline at the same time. You had to pay to have a whole nother line in your house so that somebody could use the computer and the phone at the same time, right?
Yep.
With AI right now, we're seeing a lot of different applications, but it's like, okay, how are we really using this and to sort of create that tech renaissance where it was like there's a line. It was like this was life before AI, this is life after. And same way we could look and say this was life before the internet, this is life after the internet, right? Other science, AI is devouring the majority of venture capital, similar to how tech companies were doing back then. 53% of venture capital dollars deployed in 2025 have been spent on AI. So the people with a lot of money are betting on AI, and companies that create or utilize AI, support AI. And if there is a bubble, that means simply that the market must correct itself. A correction will happen at some point, and the value of these companies will go to where they need to be in order to sort of keep this whole system going. So if you are investing for your future and saving for retirement, if you are employed in the tech industry, you should definitely keep an eye on the situation, but also talk to your financial professional to help you understand your portfolio and what's going on with your finances overall, what investments make sense for you in your specific situation, different ways to mitigate your risk and risk exposure. And for that, and all of your other financial needs, of course, you can reach out to your friendly neighborhood advisor at 315-748-5540. Again, that's 315-748-5540. Or you can send me a quick note at michael.jennings@brackensfsn.com.
Mike Jennings is a wealth advisor with Brackens Financial Solutions Network, LLC, and a registered representative of LPL Financial, member SIPC. He is your friendly neighborhood advisor.